November 13th, 2023. If you saw my video on Friday, I mentioned that we were probably going to try and test this high if we got a gap down. And the reason for that was that we got so many closes above the moving average in a row. We got 64 closes above the moving average in a row. And whenever you get something like that, that high is always going to be a magnet because the bulls are getting their first chance to buy at a below average price. Think about it. Bulls have been paying, this is the moving average, and bulls have been paying an above average price for 64 bars, and they've clearly been willing to pay it. And so now, after this gap, they're getting a chance to pay below that average price. And so, you think they're going to take it? Usually, they usually will. And the market sometimes, it'll occasionally go up in a spike, but usually it's going to be some kind of channel when you get this big of a gap down. But we do end up getting a channel up, and then the test of that high, and that's where there were sellers, and that's why there were sellers there. It's because usually it's a moving average gap bar. I have a couple examples. Successful. Here's another example. We got a gap bar after more than 20 closes below the moving average. We went above it. You could sell the gap bar, and we went back to the new low. We tested it, and you see there were buyers. So that's pretty common in trends, and sometimes it'll be a gap after the whole trend day. Additionally, I thought that the daily chart was really important today. You can see we had this high, November 9th high, and then we got a surprise on November 10th. And when you get a surprise, the bears who sold above November 9th are now concerned that they might be trapped in. So if they're concerned that they're trapped in, what do you think they're going to do when they get a chance to exit around break even? They're probably going to take it. You can see this was that Thursday high right here. And you can see when we got there early in the day, and that's where the buying started. And that's one of the reasons the buying started is because of the daily chart. The bears were concerned that they were trapped and they were buying back shorts, and that's what was part of what was causing the rally. We had a big bear bar on bar one, closing near its low, or on its low. It's a good bear bar, but the context is really bad to sell. You're selling against a really strong bull trend that's probably going to get a second leg up. It's also the bottom of this bull leg, so it could be the potential start of a trading range, and there's a lot of reasons for there to be support, like the ones I just mentioned. Bad follow through on bar two, which is somewhat expected. If you sold below one, it is a bear bar on two, but what did you actually want to see on two? If you sold below one, you wanted another big bear bar. You wanted a bar like probably a little bigger than 48. You wanted big follow through with the bears, as big as you could get, and you just don't get it on two. Same thing with bar three. 1, 2, and 3 are all bear closes. So you do have follow through on 2 and 3 for the bears, but it's pretty much the minimum follow through. And you really want to get better follow through than that if you're going to be looking to sell. Bar 4, bull bar, with a reasonably good close, but it's an inside pattern. So it's very possible that a lot of the bears who are short are going to give up above 4. But I think bar 4 is mostly caused by bears giving up, who sold the close of 1, disappointed 2, gave it another bar, because sometimes we get 1, pause, and then a big second leg down, but you don't get it on 3, and so they start buying back shorts, and that causes 4. But disappointing follow through for the bulls on 4, or for the bulls on 5, they get disappointing follow through. It might be a 50% pullback. I'm not sure if it quite got there. Not quite a 50% pullback. But the bears sold again, and it's a tight trading range now, so you don't really want to sell below 5 either. Some bulls will buy above 5 and they'll scale in lower and look to get out around break even, or break even on the first entry with a profit on their second entry if they're scaling in below 5 and below 3. And that's exactly what was happening. On 6, bulls were buying. So stop order bulls haven't made any money yet today. Limit order bulls haven't made any money yet today. Stop order bears haven't made any money. Limit order bulls were willing to scale in and they made money. If you bought above 4, you were able to make a 1-point scalp, and that's pretty much all the money bulls have made today. So a lot of disappointment so far. 6 is a double bottom with 4, and it's a potential swing up, but disappointing tail on top. So I think it makes more sense to wait and see what you get. And that's 7 is exactly why I would recommend waiting, because a lot of times if you're going to buy above a bar like 6, you're buying a bar that has a big tail on the top or a disappointing tail on the top at the top of a tight trading range. So it's probably better to wait. Additionally, it's a tight trading range, right? And in trading range price action, traders who sell below bars and scale in are going to be able to exit with profit usually. And if you sold below 5 and you sold more higher, say above 6, you can see those traders on 7. It went back to their entry price during 7, and that's why they were buying back shorts here. And that was what was causing this rally. So if you bought above 6, do you want to see 7? Not really. You wanted a really good bull bar strongly breaking out of the tight trading range, and you didn't get it. And that's why you get another disappointing doji bar on 8. Bulls want strong bull closes and they're not getting them. I think at this point, you've been in a tight trading range for 6 or 7 bars on the open. It's better to just leave everything alone until you get a strong breakout. Don't be selling reversals like 11. And additionally, the context of the day is bullish, right? This is strong enough to get a second leg up, and you should be expecting a second leg up because of the gap bar. So bears are going to have to give you a lot of proof that they're in control if you're going to take a short. And I don't think, that's enough proof on 11. I don't think I got there yet. Yeah, I was on 9. So outside up bar on 9, it's a couple legs up to the top of the trading range. Some sellers at the open of the day. 10 trades back down. Just tight trading range. You can go through and explain the minute details, but it's not really necessary. What you need to know is at this point, you should not be doing anything. And then you get 11, and some bears would argue that it's breakout pullback. So you have a spike, and then you have 1, 2, 3, and a 3 push pullback, and a swing short below 11. And maybe, but if you're going to get a swing below 11, you're probably going to be looking to sell and hold for 20 plus bars. So if you think this is going to go for 20 bars, is there really any reason you need to be in on the first bar? It's pretty low probability that you're going to get the follow through you want on bar 12. And a lot of times you're going to get trapped like the traders did here who sold. And so if that's the case, I think it just makes more sense to wait and see what you get on 12. If you get a strong bear bar closing near its low and it was the ideal follow through for 11, then great. Then you take the sell. A lot of the way I like to think about it is if I'm going to take a trade and I know it's lower probability, just wait for the follow through that you would have wanted. So if you were going to sell below 11, what is the follow through that would make you think, oh, I'm probably about to make a lot of money? If you sold below 11 and you got a big bear bar closing down here, you'd probably be thinking to yourself, well, I'm probably about to make a bunch of money. And it makes way more sense to just not get trapped on 11 and wait for that follow through that would make you think you're about to make a lot of money and then take the sell there because it's higher probability. So those traders get trapped and you get outside up on 12. When you get outside up on 12, probably not a reasonable buy above because, again, you have a disappointing tail on 12 and you're in a tight trading range still. So it's better to just wait for follow through. And you get that follow through on 13. And it's notable that the tail on 13 is only like a tick. It's really not a disappointing tail on top of 13. And so I thought 13 was a reasonable swing buy. Additionally, it is the first close above the moving average today. It's possible we're going to go more sideways rather than up because this is a bull channel. This whole thing was a bull channel. And you can kind of see the bull channel forming already. And generally what channels do is they disappoint by the closed traders and they reward traders who are buying below bars. So for example, 21 is a strong bull bar, but it never triggered. But you could have bought below 21. 24 is strong bull bar, but you get disappointing fall through 25, 26. But the traders who are willing to buy below bars in the bull channel are the ones making money, buying below 19, buying below 21. And, they weren't able to buy below any other bars. But my point being, it's okay to buy closes of strong bars in the tight channel. You have to recognize if you're buying the close of 21, you're buying the top of a tight channel. So you're probably going to have to sit through a pretty immediate pullback. If you're buying the close of 24, you're buying the top of a tight channel. It's probably fine, but you're probably, again, going to have to sit through a pretty immediate pullback. So you just have to keep that in mind. And then you get bad follow through on 14. 14 was tough because it closed on its low. And that'll make a lot of traders exit below 14. But if you do exit below 14, I think you have to buy back your trade above 15. And the reason being, what is your premise if you bought above 13? Your premise if you bought above 13 should be that, this is essentially a moving average gap bar. 6 could be called the moving average gap bar, and you're hoping we're going to get all the way back up here. When you see 14, the reason you're exiting is because you're concerned that the bears are going to get a big follow through bar, and that if you bought above here, it's possible that you're going to get trapped in for a major loss. So your concern is that 14 is going to get big follow through on 15, and that's what's making you question your premise, and that's why you're exiting below 14. However, on 15, you don't get what you were scared of. If you're exiting below 14, you're scared that you're going to get a bar like 11 on 15 and a big, strong bear close. But you don't get that on 15. You get a bull bar. So now the premise that you were scared of is no longer valid. And so you need to now think back to your original premise. If the premise that made you get out is not valid anymore, then you probably have to get back in. And that's why I think it's reasonable to buy above 15, hoping that we get more follow through. And you can probably just throw a stop below 15. You might want to use a slightly wider one, maybe a couple points below 15 in case it trades outside down or it immediately trades down and then bounces up. But in general, if you get a bear bar on 16, your premise that we're going up here is probably not valid anymore. And so that's why I think it's okay to buy above 15, probably stop below 15. Big follow through on 16, but disappointing when we found sellers above 1. And the disappointment is a reminder that this is probably all still, we're still in a trading range. It's a tight bull channel, but tight bull channels are going to disappoint stop order traders. So you're probably going to get disappointing follow through like you do on 16. However, 16 does do essentially the bare minimum and close above the breakout point, which was the 14 and the 15 high. But it doesn't close above the 1 high, which traders would have really liked to see. You get another big bar on 17, and the bulls are doing the minimum, and they're doing more than the minimum, but it's not great. It's not strongly bullish. They're not, the probability isn't as high as you'd want it to be, because it's a tight channel, so it's okay. It's obviously good to be long. You'd much rather be long than short, because the premise that we're going up here, but it's making it really hard to want to buy closes when you're getting a big tail here and then a big tail here, because this could be 1 pullback, 2, and a second leg trap on 17. So there's always problems with buying the closes in tight channels. And then 18, disappointing follow through for the traders who bought the close of 17, hoping we were going to get a quick rally up. And that's why there were sellers above 18 when we got up there. And trader bears will sell above bear bars, hoping they can make money. 19 was pretty much on its low for the last 15 seconds to the bar, and then it got bought up. Why? Because it's a tight channel. So bulls are going to be buying, and tight channels have a lot of trading range price action, which means a lot of things are going to be disappointing. And by the time things look clear up here, most of the profit's already gone. So that's the thing about trading range price action, is by the time it becomes clear, most of the money is gone. And so you have to be willing to sit through this kind of unclear stuff. Excuse me. This unclear bar like 19. And if it closes on its low, bulls might have to exit below, but it doesn't. It disappoints the bears by not closing on its low. And that's why you find buyers below on 20. But 20 can't close on its high either. If 20 closes on its high, that's really good for the bulls, but it can't. And so again, disappointing trading here. Follow through on 21 for the bulls, and it's really the first time that bulls have gotten good follow through since the breakout, and we're obviously in the channel phase right now. And since it's the first good bull bar, what should you be thinking? You should be thinking the traders who buy to 21 are probably going to be disappointed. It's always in long, and it's a bull close, so it's okay to buy, but you're probably going to be at least temporarily disappointed, and that's why you get the big tail down on 22. First stop placement on this day, I think you just trail your stop at every new high. So if your stop starts out below 15, you get a strong close on 18 above the 1 high. That's good. Then you get a pullback, and then 21 closes above the breakout point of 19 and 20. Breakout point, essentially just think of where weak bear stops would be. So once you get this close on 21, your stop can go below 20. And then you get a deep pullback below the prior bar, so you get another pullback, and then another breakout on 23. Once you get 23, it's okay to pull your stop below 22. And you essentially just keep moving it up. Once you get 27, your stop can go below 20, 25, or 26. And you just keep doing that until we get to that high. And that's exactly what traders did and where they took profits. But I believe I was on bar 23. So 23, a bull bar, but again, a disappointing close, not able to close on its high. Bulls wanted a better close, but still okay to be long, still okay to buy the market. We are in a tight bull channel. More follow through for the bulls on 24. Then you get a bull bar closing near its high at this point. It's a little too soon to be thinking that we're going to vacuum up to this high, but generally as you get closer, the bull bars get stronger because traders are becoming more and more confident we're going to get to that high. And it's becoming a higher and higher probability. So the traders buying above 27, think about what they're doing. They're trying to make 4 points, and they're risking a little over 4 points. So their risk reward isn't all that great, but their probability is really high. And they don't want to see the market dip down. They don't want to see it pull back, because that would invalidate their premise. Their premise is that we're just going to get a vacuum test of this high because we're so close and the probability is so high that bulls are just going to buy the market, and which is exactly what ended up happening. But on 24, it's still kind of a swing because you're still 7 or 8 points away. And if you just put a stop below there, below 24, you're getting about 1.5 to 1. So maybe it's like 55% that we're getting up here at this point on 24. Though I'm not super positive, because why are you getting the bad follow through on 25 and 26, right? But these buy the close bars are going to have disappointing follow through on trading range days. So disappointing follow through 25, 26. Occasionally you'll get a big bear bar here, and you gotta get out. At this point I was kind of trailing my stop. I trailed my stop below 24. in case we started to collapse. I didn't want to. Sometimes in channels you get kind of a like exact 22 is a prime example. If 22 closes on its low, you just lost 5 points of profit, which is pretty huge on this day, and you have to exit below here. So sometimes in channels you can start to use a tighter stop as you get closer up to your profit target, and then you get a big bull bar on 27. Tells me we're probably going to this high. Bulls buy the close, and you get big follow through, basically parabolic follow through on 28 to that new high. Sidebar on 29 is just traders selling out of their longs pretty much, and then you get disappointing follow through for the bulls on 30 and 31. And at this point, you have to be thinking, we got to the target, which was essentially last week's high, and now what are we going to do? I personally thought that we might try to form some sort of major trend reversal for the bears and get a swing down. And since we didn't end up getting the major trend reversal today, it's possible we get it tomorrow. But I think more likely we're going to end up gapping down tomorrow, and most of the edge will be erased. If we don't gap down tomorrow and we're gapping somewhere in here, then I'm personally going to be looking to sell early in the day because we have essentially a strong trend and then a trend line break, and we have an attempt at a lower high major trend reversal, but bad follow through. We're trying to get a major trend reversal, but we keep getting bad follow through. And I think it's more likely that we go down than up at this point as we're a little overbought. So if we don't get a gap down tomorrow, I think we will because the edge, in my opinion, is to the downside right now. But if we don't get a gap down tomorrow, I'm personally going to be looking to sell early in the day. So 32, bear bar closing near its low. It's a good bear bar, but not worth shorting with how strong this is. We're probably going to get another leg sideways to up. And that's why you get bad follow through on 33. If 33 had closed on its low, it's a big enough bar that some traders will start to wonder if we're just going to collapse immediately. But you get bad follow through on 33. And 34 is an inside bar, and it could be some sort of second leg trap. And realistically, if we were just going to immediately collapse, you need big, strong bear bars like 33 to be closing on their lows. You don't need small inside bars like 34. And then that's why anyone who was selling during 33 is disappointed with 33 and 34, and traders start buying back their shorts, and that's what causes 35. And we get a rally almost up to the 31 close, which is probably the top of this trading range. 36, it's a bear bar closing near its low, but in order to see this a major trend reversal here, you really want to see the market trade down and then retest like it did on 50 and 51, which actually I'll get to that in a minute. But you really want to see it trade down and go sideways for a little while because the longer the market goes sideways, the less influence this bull move has. Generally, after 20 bars, the bull trend will lose its influence. And so when we're starting to get a reversal down here on 36, we were in a bull trend, 5 bars ago. So do you really want to be selling 36, which isn't all that great of a close anyways, when this bull trend is still in effect? No, you want to be waiting till bar 50, 55, somewhere over here, maybe in that 230 Eastern window to be selling for a swing. Bad follow through on 37, which is expected. Any trader who sold below 34, disappointed 35, and is now getting out at break even during 37, which if you're a bear, is that what you want? No, you want bears to be selling more here aggressively. You want them to be continuing to short. Instead, they're buying back their shorts, and that tells you that this is not a strong bear trend, which is what you were hoping it was if you sold below 36. 38 is an inside bar. But just a doji. It's a high too. But again, some traders would argue you can buy above for a second leg up, but it's a doji bar, and this is a doji bar as well. And I think the bulls have lost a lot of their, the bull premise in general has lost a lot of validity now that we've traded above this high. 39, an outside down bar, but bad close and bad follow through on 40. Pullback 41, 42. And some traders would argue, again, trying to buy above 42, hoping that this is going to get a second leg up. And it might, but I don't think, it makes more sense to just wait for good follow through if you're going to get it. We're in a tight bear channel, or a reasonably tight bear channel right now. So it doesn't make a lot of sense. I'm trying to get this to, doesn't make a lot of sense to be buying. Follow through, bear bar 43, bears don't let 42 trigger, and follow through on 44, but you're now selling the bottom of a tight channel. So you're selling the bottom of a tight channel. This bull trend still has some influence. And generally, if you're going to see a major trend reversal, you're going to get at least some kind of pullback first. And you just don't get that pullback yet. And so I think that 44 is more than likely a trap. And it could just be a vacuum test of the 22 high, which is exactly where we were. And that's why traders bought back their shorts, because traders who sold above 22 got trapped. And so if you're selling 44, you're selling right where traders got trapped, which really is never a great idea.
Big bull bar on 45, but it just gets back to the 42 close. Any buy the close bulls on 42 never, it never traded above, so they got quickly trapped and they're exiting around break even during 45. Bad follow through for the bulls on 46, so big tails here. Bulls were hoping to get some strong closes that they could buy for a swing, but they get disappointing closes 45, disappointing 46. So the bulls start to give up, and that's what causes the big move down on 47. Additionally, look at 47. How do you feel if you sold below 44? You're disappointed in 45 and 46. So on 47, when you get a chance to get out at break even really quickly, a lot of those traders are going to take it, and that causes this pullback. 48 is a strong bear bar closing on its low. It could be a second leg trap, 1, pullback 2, but it's an inside bar, and potentially this was the pullback you need for the major trend reversal. I thought 48 was a credible swing sell, but then you get 49. And what do you think when you see 49? If you're selling 48, you want to see another bar like 48. You want big follow through. You don't quite get it on 49. I think if you're trading from an always in perspective, it's okay to stay short and just look to exit above a bull bar or a couple points above 49 or something like that. And then when you get the disappointing follow through on 50, a lot of bears, any always in bears who are short below 48 are going to exit, hence making 50 probably a reasonable buy. Now, I was looking at this point, and it's, you always have to be open to anything. So I thought it was reasonably likely. It wasn't super likely. It was low probability that we were going to get a second leg up. But I was noting that if we're going to get a second leg up, this second leg needs to, it needs to have a perfect start, because the context is not that great for a second leg up kind of day. If you're going to get a second leg up kind of day, usually it's going to start somewhere in here, but it needs to be really sorry. You need really strong bars. And 50 was a really strong bar. So I thought 50 was an okay swing buy. But if you're buying above 50, again, you need perfect follow through. And you get pretty much perfect follow through on 51. It could be the top of an expanding triangle, which could be some sort of final flag for the bulls. But that's one of the problems with it. You're also buying in the upper portion of a trading range, but you are pretty much getting perfect follow through on 51. You wanted it to close a little higher. The tail is mildly disappointing, but it's probably still okay to be long above 51. And so bulls getting perfect follow through 50, 51, they want, again, perfect follow through on 52. You want a big bull bar looking like pretty much exactly like 50 on 52. And then they get a disappointing small bull bar. And when they get the disappointing small bull bar, it makes traders think, well, this is just the top of the trading range. And they knew they needed pretty much perfect follow through, and now they're not getting it anymore. So what's going to happen? Those traders are going to flatten. And you can see they flatten their positions, and that's what's causing the bear bar in 53. Can you sell 53 for a swing? Probably not. Maybe, but I get the logic of the trend line break and the lower high major trend reversal. But if this is going to go, what are you looking for? If you're selling below 53, you're looking for a big move down. You're looking for, a giant bear trend, and it's low probability that you're going to get it. So why not wait for better follow through on 54? If you get good follow through on 54, great, so sell that. And then, you're good to go. You're in. But you get disappointing follow through on 54, which is pretty common. And that makes traders think we're going to get back to the 52 low. And so because traders who bought below 52 did a reasonable thing, so traders start to exit once we trade below 54 rather than selling more. You get disappointing follow through 55. A lot of bulls will exit, or bears will exit. You can see 56. We're trying to test back up to here. Inside bar on 57. Also, anyone who sold below 54, disappointed 55 is exiting around break even during 56. Buyers below 57 during 58. You can expect there to be buyers below since it's 3 straight bull bars. And this was strong enough to get a second leg up. And the second leg up ended up being 3 pushes. So it was essentially a wedge. So 59 bull bar, but tail, and 60 bull bar. And it's a good bull bar closing your high, but it's not that big. And this is a disappointing tail, and you're trying to break out of a tight trading range. And you're also right at the 52 close where bulls who think about if you bought the 52 close. Does this make you happy? No, you're very, you're upset about this. So those traders are going to be exiting, and that's what's happening. Or I should say you're disappointed. That's a better word. But those traders are disappointed, and they're exiting around break even, and they're selling out, causing 61. Can you sell 61 for a swing? I think it's the same logic as trying to sell 53. If 61's an outside bar, maybe because it's breaking out of something, but 61's not really breaking out of anything. So I would, why not wait for 62? If 62 is a big bear bar, if 62 looks like 48, then great, take the sell, and you're short here with a higher probability of making money. But you end up getting disappointing follow through. On 62, we trade up above this high and then
go down. And trading ranges often run, skunk stops, and which are just poor stop placement for trading ranges. And if you sold below 53, you can see it ran your stop, and then it kind of started to do what you were hoping it was going to do, which is pretty common. And we got 64, essentially that wedge top, right? One, pullback two, and the second leg is a wedge. Oftentimes in double tops, the second leg ends up being a wedge. And you get a big bear bar on 65, but why is there this disappointing tail? Bears have been looking for a major trend reversal all day, and they might be getting it on 65, but why is there a big tail? If we're going to go down for a lot of bars, you need 65 to close strong. And when it doesn't close strong, traders are disappointed, and they end up scalping out, and that's what's causing this tail on 66. And can you sell 66? It's an inside bar, but it's not what you want. You don't need small bars right now. What you need is big bear bars with big follow through, and you're just not getting that. And that's why when 67 trades down, traders end up scalping out on 67 rather than selling more. And trader scalping out is what's causing the tail on 67. And then you can see on 68, we tried to trade back down and we trade below the breakout point of 65. But anyone who is short here has now been disappointed twice. This looks like one pullback two and a couple legs down. So a lot of traders are expecting two legs sideways to up, which you start to get. Which you start to get on 68 and 69. Probably going to get back to the 64 low. Traders who bought below 64 are going to be able to get out at break even, which we do on 71. Again, you don't want to buy up here. You're buying the top of a trading range. This really isn't that strong, and this just looks, kind of climactic in a way. It's not like a big climax, but it's a strong bull bar at the top of a trading range with, bad bull bars preceding it. It means we're probably not going much higher. I thought how strong this was. This being this strong influenced the fact that we didn't end up getting a major trend reversal today. If this move up had been a lot weaker, I thought it was more likely that we end up getting the major trend reversal. But this, when you get this, you should be thinking it's less likely that we're going to get the major trend reversal. So you need more proof. So you need to be less aggressive with reversal trades. And that's kind of one of the reasons why I thought we ended up continuing sideways. And obviously we get two legs into the close. In 72, you could argue, well, it's the outside down bar and maybe we're going to sell off and maybe we will. But again, just wait for more follow through. If you hadn't been waiting for follow through today, you've gotten chewed up. And if you were waiting for follow through today, you haven't lost any money on, these kinds of reversals. And then you kind of get it on 73, but it's not big enough. You want a big, strong bear bar closing near its low, and you just don't get that for any of these. And then you can see on 77, we're kind of just testing the 49 high and trying to let, the traders who sold the close of 49 or the high of 49 out at break even. And that's all that's really doing. For stop order trades today, there weren't very many. I thought 13 was fine, and you could buy, pretty much above any breakout. So like you get, sorry. 17, pull back 18, 19. So you can buy again above the high of 19. Why? Because weak bears sold below 19 and they're going to be getting stopped out. Same reason you can probably buy above 14. Weak bears sold below 14. They're getting stopped out. You're buying where bad stops are getting run. And you can pretty much do that all the way up. You can buy above, above either one of these bars, but you're kind of getting pretty high up in the range. You can maybe buy 27 for a scalp. But it needs to go pretty quickly if you're going to be taking a trade like that. Again, I thought 48 was an okay sell, but you probably have to be pretty quick to get out. At the latest above 50, I would think you have to get out above 50. And that was pretty much it. And we just ended up going sideways. On the daily chart, it's kind of bad follow through for the bulls. They were hoping to get better follow through, and I think tomorrow will further disappoint them. We broke out of the top of this trading range, but I think we're just going to oscillate around here for a couple legs sideways to down. The weekly chart, I wrote this morning in my notes that I thought if we traded above this high, there would be sellers. And therefore, if there are sellers, we might get some sort of major trend reversal attempt. And later this week, we might try to get below this week's low because this is kind of disappointing follow through. If you bought above, I'm going to change this chart to SPY so we can get rid of that open interest line that I just have procrastinated on getting rid of. But if you bought above this bar, you probably wanted better follow through than just this. You probably wanted a big, strong bull bar closing near its high because this is a pretty tight trading range and it's probably enough for this is a pretty tight bear channel and it's probably enough for a second leg. Therefore, I think it's more likely that we end up we end up getting disappointing follow through for the Bears who are selling here, and we might possibly. I don't think this week we're going to get back to this week's this 1023 high, but I think eventually we will. So potential for an outside down week this week, but I just think generally disappointing follow through for the Bears who bought above 11.6.